So my friends, welcome back. Today's topic is tax, income tax. Okay. Now, all of you know that in financial statements, okay, in the income statement, we write income tax, we write tax expense, sales less cost of sales, gross profit, less other expenses, add other income, profit before interest and tax, which is also called PBIT, EBIT, operating profit, controllable profit. Remember, we discussed in performance management area, ROI, RI when we did. Then you remove an interest expense. Then comes profit before tax. Then we remove tax and we get profit after tax. Right? Clear, everyone? Or which is called net income, which is called net profit. Clear, everyone? Now, all of you know that in whichever country you operate, you have taxation rules. Okay, taxation authority, they will make the rules that what is taxable, what is not taxable, what you do in accounting, they might not accept. Right? Maybe if there are 100 items, out of that 90 items they accept, 10 items they reject. They say no, you cannot charge this as an expense. Right? Because from accounting standard point of view, we can put it as an expense. Tax people say no, we don't consider this as an expense. Or vice versa. In accounting, we put some income. They say no, we don't count this as an income from tax perspective. Or in accounting, we are silent. We don't put it. But they say no, we will charge this year. Because in accounting, as per accounting, we have to charge next year. They say no, we will charge you this year. The tax you have to pay this year on this income. Because sometimes we have deferred income. Okay, you receive some money, but it's deferred income. Like next year because you have not yet earned it. Tax people say no, we will charge you tax now. You have to pay now. You see the difference? Clear? So normally there are 4 situations. Number 1, I am booking an expense which they don't consider. I am booking an income which they don't consider. I am not recording an expense this year. I am deferring it. But they say no, charge this year. I am not recording an income this year which I am trying to defer to next year. They are saying no, we will charge you tax this year. Okay. So when we make financial statements, we submit to taxation consultant. Okay. Normally that is your audit firm. The firm which is doing external audit for you, they also provide you taxation service because they are in a good position to advise you. They know the numbers. They already audited your account. They know exactly what is happening in your company. So what they will do, they will take the financial statement and they will add and deduct some items as per the taxation rules, and they will revise the numbers, right? As per the taxation rules. And they will tell you, okay, this is the tax you have to pay this year. But that amount is different from the amount you are booking in the financial statements as a tax expense. There is a difference between tax expense and tax paid. What is tax expense? It is as per accrual concept, matching concept, prudence concept, which we put in the financial statements. As per the accounting standards, accounting principles. And taxation people, like I told you, they will agree with you on some items, they will disagree with you on some items. So the figure which you will pay actually for tax might be different, most probably different. Clear? Like for example, depreciation. In accounting, we have different method, for example, or whatever you are using, number of years, for example. So when taxation people, their rules, they say no. On the motor vehicle, you have to charge depreciation this way, as per tax rules, which is different. It can be more or less. On building, you have to charge like this. Clear?
Wait.
So in accounting, we have different way. For example, we say no, this asset we will take on straight line. Taxation people say no, this type of asset you have to do reducing balance. Getting the story? So that is possible. Yes.
Yeah, I just like to ask, regarding this audit thing, are they, is the audit firm responsible for like dictating to the company whether it is taxes or expense or
I told you tax consultant.
tax consultant?
Now tax consultant, definitely they have more knowledge about the taxation rules. So they will inform you, right, that this figure is taxable this year, this figure is taxable next year. So they will revise it for you.
Okay.
Okay. So normally audit firms, they have a tax department also for this purpose. So because they need money, right? They need to make money, and good for you also. Otherwise, think about it. You got your audit done from one company. Now you are going to another consultant that take this one day only, please make tax return for me. So he might do, but maybe wrong, because so many things they need to know, right? So when audit is done, audit is completed, you transfer the financial statements to tax department. If the company has paid for that service also, normally they pay for it together. Okay, a company, when they approach for audit, they pay two. They say, okay, no problem, you do taxation for us also. Because there is deadline. There is a deadline. So normally, audit can be extended also. So when audit is completed, then it is transferred to tax department. Then tax department will review your financial statements and they will send an email to the audit team that please tell us breakdown of this figure or reason for this figure, full email or letter, whatever, internally, because internal department, then audit team will reply to the tax team that this figure breakdown is this reason is this of this expense, this income, whatever. Then tax people, based on that reply, if they have no more question, they will make the tax return and they will file it before the deadline. Because if deadline is crossed, so who will pay the penalty? The company will not pay. They gave you already all the information. But if the company is delaying in giving information, definitely they are responsible, right? Because their mistake. But if the company gave all the information and you are delaying their return, so you have to bear the penalty. Clear? Anyways, so that was not our subject, but I'm just giving you an idea because you are already working in different companies, and when auditors are coming and you know how the taxation is done, right? So my friends, now let's see these questions. It's not in that much of depth. Again, like I told you, the financial reporting area is not in depth. We are not studying taxation in detail here. Okay, just a know-how. What is permanent difference? What is temporary difference? What is deferred tax asset? What is deferred tax liability? Why there can be differences? What are the journal entries? On a basic level. No, that is not there. See this question. This is your learning outcome statement. They say demonstrate an understanding of inter-period tax allocation, deferred income taxes. So this is the same thing which I was just discussing with you, that in accounting, as per the US GAAP or IFRS, we have certain adjustments which taxation people might not agree with. Because of that, there will be some period adjustments. Okay. The best way to learn this topic is by doing examples. Let's see this example. Okay. Now see here. They say, for example, this is tax return. Okay. This is what? Tax return. This is financial statement. Now I told you there can be a difference between the figures. So that difference is called what? Temporary difference. Okay, so this in the tax return, whatever is calculated, that is the amount which you need to pay to the tax department. Right? When I told you there is a difference between tax expense. See, there is a difference between what? Tax expense, or the, you can say, tax benefit, we call it the reversal, and the tax payable. It can be payable more, expense less. It can be payable less, expense more. Depends on the numbers. We need to know the numbers which are coming ahead in below examples. The difference between the financial statement figure and the tax return figure can be relating to deferred income tax asset or liability. So we have another question below which is asking you distinguish between deferred tax liability and deferred tax asset. You all know what is liability. You all know what is asset. Okay. Now let's apply to the taxation scenario, right? So liability, definitely, what is liability? You are not, as per accounting, you have to pay next year or next to next year, depends whenever you have to pay. So accordingly, you will put it in the current or non-current section. If you have to pay after 1 year, non-current. If you have to pay within 1 year, current. Getting it? Asset also, maybe you are having a refund coming ahead because you are paying now in advance the taxation, so which will lead to reversal in the coming years. That is asset, opposite. Now see this. What is deferred tax liability? Very simple. Like for example, there is example also, and let's first read it. They say deferred tax liability are anticipated future tax liabilities. Future tax liabilities. So from situations in which the future taxable income will be greater than future accounting income. Right? I mean to say, for example, in the next year, my taxable income will be more than as compared to my accounting income. So when my taxable income will be more, so definitely my tax will be more or not? Right or not? Let's see this example. They are telling you the company began operation in year 1, reported 225,000 in financial income. Financial income means from accounting point of view. The company year 1 tax depreciation exceeded the book depreciation. Tax depreciation means the depreciation with tax people calculated. Book depreciation which your accountant has calculated. Clear? $25,000. So tax people are saying we will charge more depreciation for this asset. How much? $25,000 as per their rules. So the tax rate for year 1 and year later on is 21%. This is the taxation rate in this country, for example. In year 2, the book depreciation exceeded tax depreciation by 25, opposite. Because see, for example, the asset cost of the asset, it's same, right? But taxation said this year we will charge 25,000 more depreciation. Okay. So definitely in the next year, they will not charge because they already charged, right? So in the next year, I have to charge as per my method, straight line, reducing balance, whatever I'm using. But overall, the depreciation will be same or not? Like for example, let's say the cost of the asset is 50,000. The cost of the asset is 50,000. As per accounting, we said this asset has 2-year life. So 25, 25. Okay, as per accounting. Tax people said no. As per tax rule, you have to pay full this year. In the first year, charge fully this depreciation. So they charge how much depreciation? 50,000 full. So it means what? They have charged 25,000 more depreciation in year 1. Right or not? In year 2, they will charge any depreciation? No, nothing left. But I have to charge, right, from accounting point of view, because I took 25, 25. Right or not, my friends? Like this. This is what I'm trying to tell you. See, this is accounting and this is tax. So I purchased an asset, the cost was 50. So definitely cost is same, right? 50 from. So in the depreciation, year 1, year 2, I said I will charge 25, 25. They said no, you have to charge 50 in the first year total. See? So what is the impact? Impact is what? That the tax people in year 1, they charged 25 more. And in year 2, they are not charging anything. So I am charging the remaining 25. Clear? This is the example. And now they say, this is a reversal of this. This is called temporary difference. Yes, this is the one example of temporary. This is called temporary difference, which will be solved in 1 year, 2 year time and finished. Because overall, what is the depreciation? 50,000. Clear? So prepare the tax journal entry for year 1 and year 2. They are asking you. Okay. So how much was the, see this example, this is the diagram to solve it. How much was my taxable income? See this? 225,000 is my financial income. 225,000 is my financial income. So this is clear with everyone, this thing. This is financial statement. This is tax return. Okay. So in the financial statement, I put my income, how much? 225. This is year 1. If my income as per my report, 225. So as per tax should be how much? 25,000 less. Why? Because remember, they are charging 50,000 as a depreciation in year number 1. Right or not? So basically, the income as per the tax is 25,000 less. What the story? Where is 25,000 in the middle? This one. This is called temporary difference, which is the difference between tax return and financial statement. Then remember, they said how much is the tax rate? 21%, 21%, and this leads to this figure. Clear? Now, if I ask you how much tax I will pay in year 1, how much? Tell me. How much tax I have to pay in year 1? 42,000. See, what you see, the tax you pay to the taxation authority based on financial statements or the tax return? Tax return. So in the tax return, how much income is coming? 200,000. So how much tax I will pay? 42,000. This is the amount I will transfer to taxation authority. Clear? But how much I will put in my income statement as an expense? That is 47,250. Getting it? Getting the story? Why? Because of this temporary difference. What is the temporary difference? 5250. What is this? This is the depreciation which they overcharge this year. Next year they will not charge. So when next year they will not charge, I will have to pay more tax or not? More tax. You got the story? Okay, now see here. See this year 1 entry, number 1 entry. What is the entry? Income tax expense of the current year, 42,000. Definitely, because this is the expense which I have to pay. And at the same time, how much you have to pay? The same figure, right or not? See, only yellow highlighted right now. What is the entry for income tax? Payable this year. So I put income tax expense debit, income tax payable credit. How much? 42. When I will pay, what will happen? I will say income tax payable debit, cash credit with 42. Right or not?
Yes.
Now listen to this 5250. This is the important thing to understand. Remember this 5250, they didn't charge me. They didn't charge because in year one, they are taking more depreciation because of which my income is low, my tax is low. My tax is low because of this reason. Next year, my tax, this remaining amount I have to pay next year or not? Right? So that's why I have to pay, right, next year. That's why this is what? Liability. That's why we call it deferred tax liability. Because in the next year when will come, I have to settle the remaining 5250. Clear? So what is the entry for deferred tax liability? Again, we book an expense in the income statement. Because if you see how much I will put in income statement, 47250. So how 47250 will come? Tell me. How 47250 will come as an expense? I need to add both the figures, right? So I need to book expense for that also. So what is the entry? Again, debit the expense, but this time credit, not income tax payable, because I'm not paying it right now. But as per accounting, I will pay it. So that's why we call it what? Deferred liability. When I will pay next year, I will reverse it. Let's see how. In the next year, what will happen? In year two, when you will come, you will reverse this deferred tax liability, same amount, and you will reverse the expense deferred also. Because this year you are putting it as an expense, right? So next year it will be reversed. Entry reversed. And you will settle the liability in the income tax return. So overall, relating to this item, for example, whatever 50,000, let's say we assume. So we need to pay how much? The tax. See, 5250 was the tax relating to this 25,000. Any question here?
So the income tax, how is possible to show in balance sheet deferred income tax expense? Is it showing in balance sheet? No.
This,
Yeah.
wait. This item goes to income statement. This item goes to balance sheet. Two entries, right? This is income statement. This is balance sheet.
Is it possible to show on the current year expense? That one, income tax expense deferred?
This is current year expense. Yes, this is current year expense. Because see how much we are putting in an expense. 47,250. Clear? So because for every entry we have two hits, right? Before double entry. Okay, this was deferred tax liability. Now let's see what is deferred tax asset. So definitely that will be opposite situation. So let's see what is deferred tax asset. It is arise when the amount of tax paid in the current period exceed the amount of income tax expense in the current period. Opposite. Okay. Again, amount of tax paid in the current year exceed then the amount of income tax expense you have put. So it leads to what? Asset, definitely, because I am paying more. Then I think I should pay. Right or not?
Yes.
Here, see here. How much was income? Taxable income? 200. How much is financial statement? So what is happening above? I paid less. Then I think I should pay. This is my thinking as an accountant that I should pay to tax how much? 47250. Tax people say no. Only pay how much? 42,000. So as an accountant, I will count it as my liability or not? which I have to pay next year. Clear? So here, my friends, it's opposite situation. Like for example, we have any unearned revenue like rent or subscription which we receive in advance. So tax people say, okay, you receive revenue, we will tax you. You receive cash, pay the tax. Although in accounting, we cannot recognize it as a revenue. Why? Because it's still unearned. It's still what? Unearned. Because in accounting, we have revenue. We can only book when we provide the service or the goods. Right or not? But tax people say khali wali. Cash came in your account, pay the tax. Clear? So let's see the example again. So this company had accounting income how much? 500,000. Okay, this one. And taxable income how much? 800,000. Written below also, you see 800,000, 500,000. The tax rate is 21%, same like last example. The only temporary difference is accrued product warranty costs. Okay, which taxation people say we will charge you, right? Warranty, we studied last time, warranty, that you have to settle next year or next year. You receive in advance the money from the customer, but you have to serve them in upcoming years. So the taxation people say you recovered warranty, revenue, pay us the tax. But in accounting, I cannot put it as income. Right or not? Because I will only put income when the year will finish and I will see who came, who don't came. Then I will book the revenue. So they say the amounts for year 2, 100,000, year 3, 100,000, year 4, 100,000. Getting it? This is 100, 100. This is that 300,000 difference. How much is warranty amount? So I have warranty 300,000, which is to be recovered over 3 years. But tax people say khali wali. You receive 300,000 now, so you have to pay the tax now. So see, tax people say as per our glasses, this is tax glass. They say your income is 800,000, pay us 20% of it. So how much will come? 168. I have to pay to them. So what is the double entry? Remember, debit income tax expense 168, credit the income tax payable this. When you pay the income tax payable debit and cash credit. Now see the other two sides of the entries, which is relating to deferred situation. What is the temporary difference? 300,000. What is the tax rate? 21%. So if I ask you what is the deferred amount, so you will say, sir, 63,000. Then I will ask you, this is asset or liability? So you will think, how you will think, because in exam, when MCQ will come, you can forget it. So you can remember like this. You need to see whether I paid more tax or less tax. So if you see, we paid more tax, right? So definitely asset. In the last example, we were paying less tax. So definitely liability. Clear? Okay. So this figure which is written in the tax return, it is called tax base. Tax base. What the figure which is written in financial statement is called carrying amount. Right? We call it carrying amount. Book value, accounting value, anything. So you need to remember, if the tax base is more, it leads to deferred tax asset. Like in this situation, right? Because I'm paying them more. It's like, you are paying tax in advance. So when you pay, it's like prepayment. Like you pay rent in advance. You pay any other subscription in advance. So that is your asset or not? We call it prepayment. It's like prepayment. Yes. So what is my prepaid? What is deferred tax asset? 63,000. So you will debit it. This will go to balance sheet. And then this will go to income statement, 63,000. Because in accounting, we don't consider it as our expense, right? As per accounting standards, you cannot book this 300,000 as an income. So that's why my income is how much only? 500,000. So that's why I will only charge the tax I will only show the tax in my accounts relating to 500,000, not 800,000. You got the story? So this adjustment lead to less income tax expense showed in the income statement. Clear, everyone? Now, in year 2, what will happen? Because if you remember, in year 2, every year they say 100,000 will be unfolded. So in year 2, 100,000 when it will unfold, how much is 21% of 100,000? 21,000. So see, deferred tax asset is how much in your balance sheet? 63. Out of it, you can reverse 21. In year 2, what you will reverse? 21. Then same entry you will pass in year 3. Same entry you will pass in year 4, like this.
In this case, we don't have to submit it, right?
Which one?
For this, because we already paid.
Yeah. In year 2, year 3. No, when you will show entries, the auditors can see, the tax people can see that you are reversing like that. Okay, so but tax people, they don't care. They already got the full tax, right or not? Okay, next question. Now, till now we were only discussing about temporary difference. What is temporary difference? Which will be adjusted in the coming years. So overall impact is same. Overall tax is same. Whether you pay in year 1 or over 3 years, 4 years, when you will calculate it same. It's only about the time. This is called timing difference. That when you pay the tax. Now the concept is, what is the difference between temporary difference and permanent difference? Very simple. Can you tell me? Examiner asked you what is the difference between temporary difference and permanent difference. And assume I have not taught you this. What you will write in exam? Think about it. Huh? Okay. Okay, very nice. See, temporary difference means what? They also consider it as an expense. I also consider it as an expense. The difference is only they say book now. I say no, book over 3 years. Or they say book over 3 years. I say no, book now. Possible, like this also. Or income, they say book income now. I say no, I will book income over 3 years. Or vice versa. They say no, book income over 3 years. I say no, I will book income now. 4 types of situations. 2 situations in expenses, 2 situations in incomes, which will lead to deferred tax liabilities and deferred tax assets, which we just discussed above. Now there can be a situation, I say that is an expense. They say no, that is not an expense. I say what? This is an expense. They say no, this is not an expense. This is called permanent difference. I say this is an income. They say no, this is not an income. Permanent difference. They say there is an expense. I say no, that is not my expense. Permanent difference. They say there is an income. I say no, this is not an income. Permanent difference. Clear? So now the difference is about not accepting whether a particular item is an expense or income. That is called permanent difference, which will never be resolved. Right or not? I mean, if I am charging a particular item as an expense or income, and they say, Khali Wali, we don't consider it. Not now, not over the next 1,000 years. We will not count it in your return. So that is what? Permanent difference. It will not lead to any deferred tax liability or asset. Clear? For example, let's say, sometimes I have some donations, in Western countries, especially Europe also. They have something called gift aid donation. Okay, so when you do the donation or something, they will not charge you tax on that type of payment or like that, but that you can consider as your expense. Right or not? So, and also there are some items for which they have already deducted the tax at source, for example. Okay, so when you are putting in your income statement, you will put that expense, right? So it's coming in your tax, but you will not pay the tax. Why? Because they already deducted before. Because if they put now again, it means they are putting tax on the tax, double tax. How possible? Clear? Okay. So like these are some examples I gave you before here also. Not all of them you will understand, and there is no need to understand. Like for example, any penalty or something, right? So a penalty is already going in the pocket of government or not? Huh? So you are writing in your income statement less penalty, huh? To reduce your income. So they already took it from you, right? So they will say, Khali wali this expense, remove it. Right or not? Because you are intentionally reducing your income from that penalty. Clear? If you put penalty there, it will reduce your income, your tax also will be reduced. So they will say, no, remove this figure. We don't count it. Because that already went in their pocket. Clear? Anyways, so my friends, this is if examiner is asking you what is permanent difference, you will say permanent difference occur when the revenues are not taxable or expenses are not deductible under the tax law. This is the definition. This will never reconcile because they totally disagree with that. Right or not? Again, they do not result in deferred tax asset or liability. So like this, in exam, sometimes they give you theoretical question. The best theoretical question which they from examiner point of view and the worst theoretical question from student point of view. When they give you 4 statements in exam and the question is which of the following statement is true or which of the following statement is false. This type of question, how they will do. They will give you 4 different statements from different areas of your syllabus to test you. So if even like if you know this that the permanent difference will not result in deferred tax asset and liability, then only you can identify, right, that what they are telling is true or false. You got the story. So this type of questions coming too much in exam because one calculation question cannot test your understanding that much, which this type of question can test. That's why, my friends, when you are doing MCQ, okay, especially theory MCQ, you need to know why other options are wrong. When you do an MCQ and you do it wrong, definitely you will see the answer or not. Which answer you will see? The correct answer. And the answer you put, that why it is not the answer and what is the correct answer. You see only 2 options. You are not looking at the other 2 options. That what they are talking about. You have to see. You have to make notes out of it. Okay. Every theory MCQ has 4 learning outcomes. You need to write them. Then you did an MCQ correct. You said very nice, I did it correct, you move on. No, wait, go check what they wrote. Maybe what you are thinking is different and what they wrote is different. You will get more idea. And then there are 3 more options, right, which are wrong. Now tell your mind why you think B is wrong, why you think C is wrong, why you think D is wrong. And then go and see, is it the same thing written there? What you are thinking is written there or not? Maybe you are thinking something different and something else is written there. Clear? So make your ideas reconcile with the ideas written in the official answers. Maybe you are also correct from different angle, but that answer will also give you one angle, which you need to write. Make an Excel file like this. Okay. You can make topic by topic or broad topic, like for example, you are writing cost. Okay, right here, lesson learned. And then whenever you are doing MCQ, start putting here 1, 2, 3. Like this, maybe you will make 500 lessons learned once you complete your question practice. So at the end of the day, you will just come here and you will review. Read them, keep reading them, then it will stay in your mind. Before exam also, this is the only thing you need to revise. This is your master file. No need to go and do the MCQs again. Clear? On a weekly basis, you can come back to this sheet and revise. And maybe first week you will have 10 points. Second week, more 10 points added like this. Clear? And even you can share with each other this file. Share with me also. Let me see how you make it. The more you do like this, you can pass exam like this. If you don't do like this, difficult, very difficult. You cannot keep everything in this small brain.
Yeah.
Because when exam will come, you will be exhausted. You don't have time to download and upload the things. So everything should be in the hard drive. And how it is in the hard drive? When you revise again and again. Clear? So my friends, online people, clear? Very nice. So this is the difference. So remember this. Temporary difference, I just told you already. Remember, I told you there are 4 types of situations. Two relating to incomes and 2 relating to expenses. So this is what is written here. Let's see this example. This is about permanent and temporary difference. This is income statement. They say the company financial statement and taxable income for year 1 is below. Income before the effect of tax was $140,000. Okay, this is what? This is the tax income. Clear? What is the accounting income? This is accounting income. How much? 115,000. This one here. Clear? So then these are the differences. And income tax return is 100,000. This is the final figure of tax return, 100,000. Clear? So in the middle, there are some adjustments. These are adjustments. They say differences. Municipal interest income, 12,000. So see, municipal, this is relating to government. So if they are giving you some income, maybe it is exempt from tax, right? Sometimes there is some income coming from government, which is exempt. So municipal interest income, let's say this is exempt, right? So in the tax return, if you see, this is written 0. Because they don't want to charge you tax on income they are giving you. Because it's good for them when you invest in government securities, like government bond, for example. When you invest in government bond, so the income which you get for government bond, they don't tax it. To motivate people to invest in the government bonds.
CSR also.
Huh?
CSR also not taxable.
Again?
Customer, sorry, corporate, the position is, what else is donation or anything.
This is what I told you before also, right? Donations, anything relating to government, you can say which government like.
Social responsibility.
Yeah.
Corporate social
Yeah.
Yes, sir.
Okay. So government want to motivate people to invest. So that's one advantage they give, that if you get any income out of these bonds, we will not tax it. Right? Like that. Anyways, similarly, see, there was a penalty, 7,000 penalty. So in the tax, it is 0. They don't allow this as an expense. But on the other side, in the income statement, if you see, I have to put this interest income in the accounting statements, right? And also I need to remove the penalty as an expense. Clear? So these are what? Permanent differences. What is this? Permanent. But we have depreciation. So I told you they can have different amount, you have different amount. Right? So they say no, we will consider 40,000 this year. You say no, as per accounting, it's 30,000. So see how much they put? 40,000. How much you put? 30. This is the 10,000 temporary difference. Then based on this working, you can even do reverse working and you can reach to your income also. 140,000, which is reconciled income 140. That there are 3 adjustments. Two adjustments you have done, they have not done. This is called permanent differences. And then there is an adjustment you are also doing, they are also doing, but different figure. This is called temporary difference. Then we got to know that as per the accounting, the income is 115,000. As per the tax, they say the income is how much? 100,000. So definitely the tax is less right here. But I think the tax should be more. So it will lead to what? Remember? Same entry like we made before. So with 21,000, this is the amount you have to pay. So you made entry income tax expense debit 21,000, income tax liability credit 21,000. Then the difference came. How much? 2,100. This is called temporary difference relating to liability because next year you will pay. So you book income tax expense again, debit, deferred, and the liability credit 2,100. So this will go in balance sheet, this will go in income statement. Net of how much will go in income statement? These two together. Right? If you see in income statement, how much I am putting? 23,100. The breakdown of 23,100 is this. Because I put in income statement this figure, but when you will go to the cash flow, remember when we make cash flow statement, we put how much actually we paid the tax. So over there, how much you will see the tax? This one. Clear? So the difference is what? This is the deferred. Done. And also this will go to where? In the balance sheet. This will also go in the balance sheet, and when you pay that, you will remove it. Like that. Getting the story. So this is what it is for the taxation perspective, as simple as that. So you need to remember what is temporary difference, what is permanent difference, what is deferred tax liability, what are the double entry, what is deferred tax asset, what is the double entry. Right?